Options trading is an exciting avenue for investors to navigate and potentially profit from the dynamic movements of the stock market or individual securities, such as stocks and bonds. Options, in essence, provide you with a unique choice, offering the opportunity, but not the obligation, to buy or sell an underlying asset at a specified price by a predetermined date. What exactly are options, and what are the two critical dates that you need to know? Well, I'll answer that and more in this video. Thank you for watching this video. But before we begin, if you could, please take a minute to subscribe to my channel. And if you enjoy this, make sure you hit that like button. Also, if you know someone interested in options, please feel free to share this video with them. Now let's get started. Think of options as tradable contracts that empower investors to speculate on whether an asset's price will rise or fall at a designated future date. The beauty of options lies in the fact that you can engage in the speculation without actually committing to the purchase of the asset itself. Now, while options might seem a bit perplexing at first, they're not as complex as they may appear. To grasp the concept of options, let's familiarize ourselves with a few key terms. Derivative. Options belong to a category known as derivatives, meaning their value is derived from another underlying asset. For instance, the value of a stock option is influenced by the price of an associated stock. Call option and put option. A call option provides you with the chance to buy a security at a predetermined price by a specified date. On the other hand, a put option allows you to sell a security at a future date and price. Strike price. The predetermined price mentioned earlier is the strike price. Premium. The cost to acquire an option is called the premium, calculated based on the underlying security's current price and values. Intrinsic value and extrinsic value. Intrinsic value is the difference between the option contract strike price and the current price of the underlying asset. Extrinsic value encompasses other factors that influence the premium, such as the time remaining until the option expires. Now, when it comes to options trading, you probably already know about the expiration date. But did you know there are two more absolutely critical dates you should know about? The earnings date and the ex-dividend date. Let's start off by going over what the expiration date is first. Let's simplify the concept of expiration dates in derivatives trading. Think of expiration dates as the final dates for options or futures contracts, the last day they're valid. On this day, a deal is settled between the buyer and seller. Now, to understand why this matters, let's talk about derivatives. These are like contracts between two parties, and their value comes from the performance of something else like stocks, commodities, bonds, indexes, or even currency. People use derivatives to manage risk, also known as hedging, or to take a chance on something, also known as speculation. There are three main types: forwards and futures, options and swaps. Now imagine ABC Company, a farm heavily relying on soybeans. To protect itself from price changes, ABC enters an option contract with the farmer to buy 100 bushels of soybeans at a fixed price of $900. The option is usable only before the expiration date, set for January 19, 2025. If soybean prices go above $900, ABC can buy at the agreed upon price. The expiration date's details depend on the type of derivative. For a large number of stock options in the US, it's usually every Friday. Now let's talk about the value of options. Regardless of whether it's a put or a call option, those with longer expiration dates have higher time value. More time gives the option a better chance to reach its price, increases its time value. So two options with the same price, one expiring in May 2024 and another in September 2024, will have different time values. As options near their expiration, if it's out of the money on expiration date, meaning the option has no extrinsic value, it will expire worthless. Now that you know what the expiration date is, let's talk about one crucial aspect of options trading that can significantly shape your investment strategy: earnings dates. Earnings events are pivotal moments in which investors gauge a company's fundamentals and decide whether to continue investing. Without the right risk structure, participating in an earnings event might expose you to more financial risk than anticipated. Investors closely track earnings events as they provide key insight into a company's growth or potential stagnation. It's the interplay between how the company is perceived and the reality of its performance. During an earnings event, a company discloses essential financial statistics, including earnings per share, overall sales growth, profit margins, and forward guidance. This is followed by a conference call where leaders discuss operational results and future outlook. Analysts and investors pose questions during this call, offering an opportunity for deeper insights. At its core, an earnings event informs investors about a company's performance. However, it goes beyond that. The market already has performance expectations discounted into the stock price. The earnings event acts as a litmus test, determining whether the company met, exceeded, or fell short of these expectations, resulting in terms like earnings beat or earnings miss. The aftermath of an earnings event can trigger significant price movements, leading to what momentum traders call post-earnings announcement drift. Companies with earnings surprises tend to sustain their price direction for several months. Options trading presents an avenue for substantial returns, but it introduces additional risks, notably the factors influencing option prices known as the Greeks. One crucial Greek to monitor during earnings is vega, representing the change in an option's price versus implied volatility. Understanding implied volatility dynamics enables you to grasp how vega can impact your position. For new options traders, exercising caution around earnings is advisable. The potential risks, not only from directional moves, but also from volatility risk, may be more significant during this time. As you delve deeper into the mechanics of options trading, you can gradually incorporate strategies around earnings events. These events often create mispricings in option values, offering opportunities for more sophisticated trading approaches. Now that you know the expiration date and the earnings date, it's time to talk about the juiciest, the most exciting date of all, the ex-dividend date. Ex-dividend dates may sound like financial jargon, but understanding this concept is crucial for investors seeking to navigate the stock market intelligently. The term ex-dividend refers to the period during which a stock is traded without the right to its upcoming dividend payment. This period begins on the ex-dividend date, or ex-date, which is the day a stock starts trading without the value of its next dividend payment. To break it down, let's consider the mechanics of ex-dividend dates. Typically, the ex-date occurs one business day before the record date. The record date is established by a company's board of directors when declaring a dividend. This record date signifies the day on which an investor must be listed as a shareholder to receive the declared dividend. Consequently, if you purchase a stock on its ex-date or later, you won't be eligible to receive the next dividend payment. Instead, it goes to whoever owned the stock the day before the ex-dividend date. The reason the ex-date precedes the record date is tied to the settlement process of stock trades, known as T+1 settlement. When a trade occurs, the transaction record isn't settled until one business day later. For instance, if you sold a stock on Friday, April 8th, the trade wouldn't be fully settled until Monday, April 11th, the record date, making you still the shareholder of record. This ensures that the investor selling the stock on the ex-date or after doesn't benefit from the upcoming dividend. Understanding ex-dividend dates is essential for income-focused investors. Planning trade entries around these dates becomes crucial for optimizing dividend returns. However, it's important to note that the stock price typically drops by an amount equal to the dividend on the ex-date, making it unlikely for investors to profit by buying right before this date. The same principle applies if you purchase on or after the ex-date, as the stock is usually priced lower to account for the dividend you won't receive. In a practical example, consider company XYZ paying a 53 cents per share dividend on June 2nd, 2023. The ex-date is May 5th, 2023, meaning only shareholders who bought the stock before this date are entitled to the cash payment. There is one other crucial element to the ex-dividend date. If you sold a call option that is now in the money, meaning the stock price is above the strike price, there is a significant risk of the option getting exercised as the ex-dividend date approaches. This is because the option buyer can profit from the difference in price and the dividend that they will now receive as the stockholder on the ex-dividend date. Your best protection is to simply get out of in-the-money calls before the ex-dividend date approaches, even if there's still time before the option expires. Thanks for watching. If you have any questions or comments, please post them below. And be sure to subscribe and hit that like button. Good luck with your trading.